Hello and welcome to the latest Expert Series webinar. Today's presentation is Quality Mix, More Than the Sum of Its Parts. This is a complimentary ETF.com webinar, courtesy of MSCI. I'm Ollie Ludwig, the managing editor of ETF.com, the leading authority on news and data about ETFs, and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Reina Oberoi of MSCI and Dave Mazza of State Street Global Advisors. Reina has been in the investment industry for 10 years and has held several roles, including that of an index trading strategist. She now focuses on conducting research, and she works closely with clients. It includes asset owners, managers, brokers, and investment consultants, all to ascertain their needs with respect to MSCI's large product line. Dave Mazza, meanwhile, is a vice president at State Street Global Advisors, and he is the head of research for the SPDR ETFs and the SSGA funds. He manages a team of product sales and strategists to generate strategic and tactical investment opportunities. A bit of housekeeping before we get started today. I'll be asking some questions along the way during the webinar, but I'd like everyone to know there will be a Q&A session at the end of the formal presentation and back and forth question and answers that I will moderate. All of you can ask questions at any time during this webinar in the window at the lower right of your screens. Also, bear in mind, going into this, that this presentation will be available to all of you 24 to 48 hours following today's webinar. The world of smart beta investing has taken off in investment markets over the past few years, and especially in the world of ETFs. Estimates of U.S. listed ETF assets that could be characterized as smart beta vary from anywhere from around 200 billion to as much as 300 billion, depending on the definition. That's pushing about 10% of total assets under management, so this is clearly a phenomenon to watch. In any case, some of the most successful ETF launches of the past few years have been in this smart beta realm, whether that's older variations such as small caps or value, or funds built around newer indexes screening for single factors like a minimum volatility or dividend streams. And it also extends to fundamental indexes. And we'll be getting into today multi-factor indexes, which is really a new wave in the investment world. Specifically, we'll be looking at the MSCI Quality Mix Indexes that combine three factors into single investable products. Those factors are quality, minimum volatility, and value. The idea behind this blend is that the viability of different investment factors over time is cyclical, so combining these three factors in equal weights can enhance risk-adjusted returns. And to get right to the point, in the past several weeks, State Street has brought to market 9 ETFs in this category, all built around indexes from MSCI. These 3 are broad-based, focused on the MSCI EFA index, the Emerging Markets Index, and World Indexes, while the other 6 are built around single countries. Those include Australia, Canada, Germany, Japan, Spain, and the UK. These factor-based ETFs are cutting edge in terms of how product development is unfolding, and considering they're built around MSCI's prestigious family of indexes, it's my opinion as a journalist that investors would be remiss if they didn't at least take measure of what MSCI and SSGA together have come up with here. So without further ado, it's my pleasure to turn the floor over to Reina Oberoi and Dave Mazza of SSGA. Now, Reina, to start off, I wanted to ask you a question at the risk of asking you to repeat what I just said. Tell us about the factors in these MSCI indexes and how they can be combined, how they are combined.
Sure. Thanks, Oli. Hi, everyone. So as we all know, factor-based investing has become a widely discussed topic today. And as Oli, you asked, it's a seems like a pretty simple question, but we do get this a lot, that what is a factor? And a factor can be thought of, according to us, as any characteristic relating to a group of securities that is important in explaining their return and risk. So MSCI currently identifies 6 equity risk premium factors, as we see on the slide. These are value, low size, low volatility, high yield, quality, and momentum. And there is enough research and, there's a lot of solid explanations to show why they've historically provided a premium. And especially in the last few years, the development of the investable MSCI factor indexes has provided investors a powerful way to access these factors in a cost-effective and transparent manner. A point I'd like to make here is that investors should note that factor indexes should not be viewed as replacements for market cap indexes. Instead, they are actually complementary to market cap indexes. We, as MSCI, believe that market cap weighted indexes are still the only reference for a truly passive, macro-consistent portfolio. So in contrast, the way we should look at factors is really they represent an active view away from the market portfolio. And investors must form their own beliefs about what explains the premium and whether that premium is likely to persist. So as seen on the top right picture, we see that passive factor allocations combine attractive elements of both traditional passive and active mandates. Let's move on to the next slide, and here I'll talk a little more about how we combine these factors. So let's look at the 5 factors on this slide, and each of them can be used to access a certain source of return in the market. However, we should note that there could be long periods of underperformance in each factor, depending on which business cycle we're in. So typically, value, momentum, and size are considered as pro-cyclical factors. And what that means is that they generally do well when there is a positive shock to the economy. On the other hand, quality and low volatility are considered defensive, i.e. they perform better when there is a negative shock to the economy. So therefore, mixing these factors in various combinations can provide smoother and better returns than the market as well, and gives also investors a lower risk profile over time. So just to emphasize, one of the key benefits of multi-factor indexes is diversification. And this diversification has historically led to lower volatility, a higher Sharpe ratio, higher information ratios, lower tracking errors, and less dependency over business cycles. At MSCI, we have seen allocations to multi-factor strategies increase rapidly, and there are several reasons for it. I just mentioned diversification, and then, of course, the potential for improved risk-adjusted returns, which, of course, everyone's very interested in, and the ability to express views on more than one factor, clear attribution, the ability to implement such views flexibly, as well as reducing turnover, which it can be achieved by internal crossing at rebalances. All right, over to you, Ollie.
Raina, I wanted to ask you about the quality mix and specifically how to distinguish that from quality. I sometimes hear quality described as Warren Buffett in a bottle. Obviously, quality mix is a little more than that with the other factors mixed in. So talk about that quality mix and why is it important to investors?
So, I do cover a little bit of, the rationale kind of behind it in terms of, your question about Warren Buffett in a bottle and why we've chosen these 3 factors. So I'm going to go more into right now just the methodology of what the quality mix is. So, we get a lot of questions on what is your secret sauce? And, given that our indexes are so transparent and rule-based, there's really no secret sauce to the MSCI quality mix. It's basically an equal weighted combination of the MSCI Quality, the MSCI Value Weighted, and the MSCI Minimum Volatility Indexes. And what it aims to represent is really a combined performance of the quality, value, and low factors. So what I'm going to do is basically just quickly talk about, what do we mean by value, quality, and min vol. So value, according to us, and this is pretty much a standard definition, is stocks that have low prices relative to their fundamental values and returns in excess of the cap-weighted benchmark. And MSCI captures value via 4 fundamental variables, which are sales, earnings, cash flow, and book value. Quality, on the other hand, is thought of by us as really quality growth. And quality growth companies have durable business models and sustainable competitive advantage. And the way MSCI captures the quality premia is through high return on equity, stable earnings growth, and a low leverage. Finally, the minimum volatility is really, represented, according to us, by just a portfolio of stocks with the potential to provide the lowest total risk and, as a result, superior risk-adjusted performance. So the Quality Mix Index really provides a transparent and cost-effective way for investors to get exposure to this combined strategy.
So let's talk about what it looks like in practice if I were to want to implement this in whatever one of those 9 variations that I spoke about at the beginning. What does it look like in different economic environments? You talk about diversification of these risk premia. Can you describe this in a little bit more, with a little more granularity, please?
Sure. So, the chart on your screen kind of shows how these different factors have done in different economic environments. And we can look at some historical trends. So this chart essentially shows the cumulative relative performance of each of the component factor indexes over time. So during the long bull run of the early 2000s, we see that the MSCI value-weighted index outperformed. And the MSCI min-vol basically tended to track the benchmark, and the World Quality Index lagged behind it. Now, during the global financial crisis in 2007-2008, both the MSCI World Minimum Volatility and the World Quality Index outperformed the market, and the World Value-Weighted Index underperformed it. So we can see, that these factors, each of them have their own premia, and, investors invest in these factors individually. But with the quality mix methodology, we kind of smoothen them out and kind of, not entirely mitigate, but more or less mitigate the cyclicality of these factors.
Brandon, are you still there?
Yes. Dave, would you like to chime in?
I'm feeling we can't hear Dave right now. It appears
Okay.
Dave's not coming through. So you were talking about the cyclicality. Is there further anything you would
Sure.
say in Dave's absence?
Sure. So basically, the idea is that there are, these 3 factors that perform quite differently in different economic scenarios. And a key thing is if you look at their correlations are pretty low, which is why they actually kind of complement each other in a longer period of time. When one underperforms, the other outperforms. And then, looking at the chart on this slide, we look at the relative performance of the MSCI World Quality Mix. And this chart really reiterates the prime benefit of the Quality Mix Index. So basically, combining quality, value, and minimum volatility factors in equal proportions historically has offered a smoother ride, mitigating the cyclicality of individual factors.
Okay. Has Dave joined us yet? Are you getting through, Dave, or can you hear me? Okay. Seems like we're still having a little bit of technical problem. Anyway, I'm sorry to interrupt you. Rana, you want to jump in, continue? I apologize for the interruption.
Yeah, no worries. Basically, just wanted to wrap up, on that point on your question about performance in different economic cycles. So we do see that these factors are complementary, and if you mix them, as we see on the current slide, it kind of gives us a smoother return trend.
Perfect. Okay, Dave, if you can hear me, if you want to jump in at any time and we can hear you, then it'll be all the better for all of us. If not, let's push on.
Can I be heard?
Oh, Dave, great. Welcome aboard. Sorry about the technical difficulties. So I had just asked Rana about the quality mix performance in different economic environments. If you want to jump in there and add some color, we'd all be most appreciative. Thanks.
Yeah, no, I think that's a very important distinction and consideration, particularly when thinking about the fact that, as Rana mentioned, factors go through experience in periods of underperformance or overperformance, depending upon what their underlying exposures are doing. So we know that there are time periods where low volatility will do quite well, or inexpensive valuation or high quality stocks. And what we see is that different time periods we may want to essentially have to tilt portfolios in one direction or another. And in some cases, that may not necessarily be as beneficial to portfolios. And what we need to do is be aware of what that looks like. And so as we can see on slide 6, which I've just put in front of our audience here, is when we combine three together, particularly those that are pro-cyclical, so those that do best in certain market environments versus those that might do worse, such as cyclical factors versus uncyclical factors, what we tend to see is that we have a smoother ride through time. And potentially our drawdowns are limited. And the black line is shown as this quality mix that, of course, combines quality, value, and minimum volatility. What I think is actually quite insightful as well is if you look at the bottom part, it's when we see the correlations. And this actually, for those who want to see the picture, we can see that on the top chart using those rolling returns. But when looking at the individual correlations of these factors to another, they actually can be quite low. So again, we see the diversification benefits and the combination benefits that we can have when looking to combine those three together. So it's not just necessarily simply about the performance side. As we'll go into some detail, it actually has to do on the risk-adjusted side as well.
Got it. And when it comes to the mixing these three together, it's equal weighted, right? That's the methodology. So essentially, a third of the portfolio is exposed to each of these factors, and it's drawn from the same index in each screening, right?
Yeah, that's exactly correct. It's
okay.
A third.
And that's how it remains always, apart from the rebalancing that occurs.
Correct. That's one of the powerful benefits.
Okay, so things like portfolio turnover, relatively minimal, except for whatever happens in a rebalance scenario. Is that a fair way to look at it?
That is correct. It really can mitigate some of the excess turnover that could come from trying to introduce individual biases or so-called bets by having to essentially weigh one of those particular factors over another.
Got it. Yeah, that's good to know. Okay, now how has the quality mix performed relative to the underlying mother indexes? I mean, there is this temptation. Okay, this is great. I mean, it's like I'll put on my lab coat and get all nerdy, but might not I be better off just sticking with, say, the MSCI Emerging Markets Index and be done with it? Make the case as to why skinning the cat this way makes perfect sense, or is a clear case that it should be heard at the very least.
Yeah, I think you raise a good point, particularly with strategies of this nature, and this is where some of the concern with advanced beta, smart beta, factor indexing comes in the fact is that, okay, in isolation, one of these elements sounds great. And we know over the long run there's empirical evidence, there's academic evidence that individual factors do quite well. But actually what we can see is over the long run, you gain a lot of benefits because individual factors or premiums exist in the market. So we tend to think that markets are highly efficient but inefficient in certain areas. And one of the ways that can be exploited is by using a systematic, disciplined process that can be found with index-based investing. And in particular, the combinatory benefits that you get from combining both the more cyclical factors that Raina mentioned and those which are more defensive in nature, as evidenced by the quality mix, leads over the long run to there to be superior risk-adjusted performance relative to the parent index.
Let's talk about those risk-adjusted returns. I mentioned that briefly in the introduction, and I'm glad that you brought that into the discussion, Dave. So, from a risk-return standpoint, let's talk about that with greater specificity. How does this quality mix fare, again, from a risk-adjusted return perspective?
So they actually fare quite well. If we look at the next slide, And this really is evidence of some of the earlier points that I was making in regards to the cumulative performance. So here we were looking at the MSCI World Quality Mix relative to its parent index. And one thing I will just point out before moving on to the next slide is that what we can see is that it's a pretty consistent rise. For me, one of the benefits of this approach is it's not necessarily about hitting home runs. It's about the additive benefits that singles and doubles, if you will, can bring over time. And if you move on to the next slide, I think this really epitomizes it in greater detail. And so what we've done is we've plotted on one axis return and the other axis standard deviation. So essentially looking at my return per unit of volatility. What we can see is that, over the long run, the parent index, so here the MSCI World, that does pretty well, a little under 7% returns on average over this fairly long time period, with a standard deviation a little above 15. But what do we really see? So when isolating these particular factors, the minimum volatility is displayed with the red square, quality is there, and then in the orange you have your value-weighted index. They actually do much better in some cases from a performance standpoint. In value, you're picking up a little bit more risk in order to gain some of that performance. Quality looks like it's had gangbusters returns, and there's some good reasons for that, as this period includes some market drawdowns, the technology bubble, and the global financial crisis. But what do we find? When looking at the MSCI World Quality Mix, we see that it really has an optimal profile in this regard. And the reason being is, again, the combinatory diversification benefits. So relative to any one of the individual factors, you have a really strong, essentially, return per unit of risk over this long time period. And if you move to the next slide, I think we can actually show what this looks like for most of the investors, both institutions and advisors that I get the chance to speak with. Drawdowns and diversification in volatile markets tends to be of the utmost importance. And when looking at the World Quality Mix relative to the parent index, it really highlights this in greater detail. And what we can find is that on average, we take advantage of about 90% of returns in up markets, but only have 80% of the returns in down markets. So over the long run, by having less impactful drawdowns, really where clients and portfolios can be most hurt the worst, this is really limited by taking advantage of this multi-factor approach. We also look at this across other regions, such as EFA, so your international developed markets and emerging markets, and the story is fairly consistent. And again, this tells me that this approach, this methodology, as has been laid out, it's not necessarily just able to work in one individual market, or it's just sort of a fluke or an anomaly. It's taking advantage of persistent inefficiencies that can exist over the long run, and developing and taking an approach which we think is able to actually capture market returns in a more effective fashion. And again, as displayed here, limiting some of the impact that we can see on the downside, which over the long run leads to a lot of that strong cumulative excess return that we saw in the previous slide or two.
Right, that's that old maxim, the three top rules of money management: don't lose money, don't lose money, don't lose money, right? So I'm going to circle back to what I asked a moment ago, because you brought it into sharper focus just now. The quality mix relative to some of these other MSCI indexes, and it's a serious question, because MSCI is probably the most prestigious indexing brand, certainly in terms of the international space, single countries, and all this stuff. So those are good indexes. What's better about them? As we look at these indexes through the lens of this quality mix.
Yeah, I think you raised a good point, and in my opinion, there's no one perfect index, because every portfolio and portfolio application is going to be different. I think oftentimes we get caught in the fact that something that we've maybe used historically or something that we've come to know is the best, or conversely, that something new must be that much better. For me, it's really about thinking about my particular needs that I have. And the needs that I might have, or that we see a majority of investors really having, is in regards to be able to take advantage of limiting some of the downside that we see, as evidenced here, but at the same time, having the ability to have seamless integration with other approaches. And as you mentioned, MSCI, of course, is a market leader in indexing, particularly on the single country side and in regards to regional approaches. And so when we want to think about integrating a quality mix approach, a multi-factor type approach with a traditional market cap weighted index, there's a lot of benefits knowing that your essentially pool of securities is going to be identical, and you don't necessarily have to be as concerned, in particular with some of these countries that often can be considered on the bubble, whether or not we're in a developed market or emerging market type status, that we're going to be double counting, essentially overweighting an area unintentionally or underweighting. So I think the seamless integration that you can have between advanced multi-factor type indices in regards to the parent indices under a single framework is actually very, very powerful.
And Ollie, I'd like to chime in here.
Yeah, please.
Just on your question on, market cap indexes, which are, MSCI is traditionally known for, and now, the factor indexes, which MSCI is, done a lot of advanced research on. So basically, as an investor, the way I would, have them, or the way I would think about it is that these indexes do not replace each other, and I mentioned a little bit about this before. They actually are complementary. So, the market cap indexes, according to MSCI, are still the truly macro-consistent buy and hold strategy. And, in addition to that, if investors, want to get exposure to a specific risk premium, they actually do have to take, an active view on that. And MSCI, of course, has the investable indexes or investable factor indexes that they can use to get this exposure in a very cost-effective and transparent way. So I would look at it, through the lens of one versus the other. I would look at it versus one and the other or the other. And so it just depends on the investor what they're trying to achieve. And, just to point out on our current slide, just looking at some of the performances of, the different components of the quality mix and the quality mix in addition in relation to MSCI World, we have seen that basically all the three individual factor indexes as well as the MSCI Quality Mix Index has outperformed the market over the period that we show on the chart, and even the total risk of the MSCI Quality Mix Index is also lower than that of the parent index. In terms of the tracking error of the MSCI World Quality Mix, that's substantially lower than the MinVol or the World Quality indexes. So that being said, it really depends on what the investor is looking at. Some of them do have a higher risk, some of them do have a lower risk, and it really depends on what the investment need of the investor is. Going on to the next slide, I would just like to point out, a point that I've made earlier is about the cost effectiveness of implementation that MSCI has basically been able to give to the investment community. So one of the main characteristics that contributes to this cost effectiveness is the fact that the composite MSCI Quality Mix Index has historically exhibited reduced turnover because of mainly two reasons. One is, the natural internal crossing opportunities that you get at each rebalancing, which we discussed some time back. And then the other is really, with this single composite index, what it does is it just reallocates within the component indexes at each rebalancing. Therefore, it kind of avoids the need to reallocate capital across managers when managed in a single mandate. So if you look at this table on the slide, we see that if we were to implement these three strategies separately, i.e. we have three separate mandates, our turnover would be 4.1% higher than if we combine these three strategies into one single mandate, such as the MSCI Quality Mix.
That's great. Dave, before you joined us, there was a question maybe that you wanted to take a crack at before we push forward here. If you look at this in broad perspective, why is this indexing methodology, this putting three different screens into one mandate, as Raina just said, why is that important to investors at this point in time?
Yeah, no, I think you have the theoretical and practical implications, and of anything we do in investing. In particular with the advances that have been made in indexing that MSCI has really been a pioneer of and we're able to harness today, it goes back to looking ahead and not necessarily just looking in the rearview mirror. And to your point, when I am thinking about managing portfolios and the challenges that investors still have with equity markets performing really robustly last year on the back of really some strength coming out of the global financial crisis, significant questions about the impact that fixed income markets and the rates markets will have not just here in the U.S. but globally. When investors are looking for an approach that can provide the benefits of capturing a fairly significant amount of the upside, but reducing the drawdown, and at the same time looking to take advantage of the fact that the factors identified in the quality mix approach actually lead to a portfolio of stocks that aren't necessarily quality just simply by one individual approach, but really by looking at the lenses of both quality of earnings, quality of balance sheets. At the same time, not necessarily having to pay out significantly for that quality, so looking at multiple approaches to valuation, and at the same time finding those stocks and those securities that exhibit a low volatility. And as Raina mentioned, when we're combining those three together in a seamless approach, not necessarily trying to splice them all together, we gain a lot of the benefits that comes from internal diversification, if you will. So I think it's a really not just exciting from a theoretical standpoint, but also one that can really start being practically applied to portfolios going forward.
Thanks, Dave. You talked about the benefits, and certainly Raina started to talk about them. But let's dive more headfirst into that subject of the benefits and the efficiencies of the quality mix. And Raina, this is really one for you. MSCI's perspective as the index provider on these strategies. Speak to that again. The potential benefits and efficiencies of this quality mix. I mean, it's on the cutting edge, as I said in the introduction. So why put such effort into this?
Thanks, Ollie. Sure. So I think, you asked about this before, why did we choose these three factors in combination? And so what are some of the benefits of choosing these three factors? So many active strategies, emphasize quality, value, and low volatility as important systematic factors in their security selection and portfolio construction process. Now, while these active strategies obviously typically go beyond just passive exposure to these three factors, they, to include like active stock selection, the use of leverage, their beta component really could be represented by quality, value, and low volatility. And, empirical academic research has shown that stocks with high quality, value, and low volatility characteristics have historically performed better, in terms of a longer-term risk-adjusted basis. And, I would like to circle back on your point on, the Warren Buffett in a bottle. So there is a linkage here is that, the impressive performance record of Buffett, which may be interpreted by investors in different ways, according to us, is partly, because of such a combination strategy, i.e. combining quality, value, and low volatility. Research shows that a significant part of Buffett's success comes from buying safe, high-quality value stocks. And of course, this approach goes much beyond that than simply getting exposure to these because of his skillful selection of stocks. But as I mentioned, the beta component of the strategy can largely be captured by exposure to these three systematic factors. Now, in addition to the performance of, the quality mix, what I would like to point out is that, the performance of stocks with just one of these factors has tended to be cyclical and not synchronous with stocks exhibiting other characteristics. So, for example, we've talked about this before, when value stocks have outperformed, low volatility stocks have often underperformed. And such difference in performance cycles results in low correlation among factors and offers an opportunity to exploit potential diversification effects. Another benefit of the quality mix index is also typically it provides lower concentration in individual names compared to some of the market cap weighted indices, and this is mainly because of some of the capping rules that we have in our methodology. So I would like to kind of go a little bit deeper into some of the efficiencies of the quality mix index versus traditional market cap weighted benchmarks. So investors may experience less tracking error if they use the quality mix indexes, but also benefiting from the factor premia that they actually represent. You already talked about lower turnover of combining these indexes, using MSCI as opposed to using different providers and combining indexes, just because using our universes will be consistent, and it'll also provide lower turnover because we have a synchronized rebalancing schedule. And then a point I really need to emphasize on is the seamless integration with the MSCI parent indexes. And David already highlighted this, but the way the quality mix indexes are really based on the parent MSCI indexes, which are the market cap weighted indexes used by a large number of advisors and institutions. So basically, we start with the market cap weighted indexes, for example, the MSCI World, and then the value weighted, the minimum volatility, and the quality indexes are constructed from this starting universe. The quality mix then takes 1/3 of each and combines them together to make this quality mix composite. So essentially, MSCI starts with a broader market universe and then tilts the portfolio towards certain factors. So it kind of retains all the all the efficiencies that you can find in a market cap index, i.e. investability, replicability, all of those benefits that the traditional MSCI indexes have to offer. And then it also provides exposure to these specific factors or whichever factor an investor might be interested in.
Okay, thank you very much. I think where does the rubber meet the road is always the question. Let's talk about implementation. Actually, I'm hearing a little background noise. If I'm not sure who it is, just a mute button would be probably appropriate. So in the implementation frame of reference, I think both of you, Raina and Dave, you did speak to this a bit earlier, but I want you to get into it in greater detail. How do you conceive of a quality mix integrated into a broader portfolio? Standalone, yes, or a mix? I think Raina, you said it's not all in, all out. There are different ways to do it. So shed some light on what that could look like. I think Dave, maybe you might be an appropriate person to start out with here. Raina, if you want to chime in, please do. But Dave?
Yeah, Ollie, thanks. I'll jump in here. Before I do so, I just do want to highlight what the offerings are today. And we mentioned a lot on some of the benefits of the quality mix approach. And as we alluded to, we used a lot of the data from the broad-based MSCI World type approach, so your full global mandate, if you will. But what we found is that this works in multiple settings across multiple regions and across multiple countries. So what we brought to market in the last month in conjunction with our indexing partner MSCI is 9 quality mix ETFs, 3 focused on regional approaches. So as I mentioned, the world, EFA, emerging markets, but also for country-focused investors, we have 6 country funds, and these include Australia, Canada, Germany, Japan, Spain, and the United Kingdom. And they're all offered at 30 basis points. So all of them have a similar price point, which can be integrated into portfolios.
Each of the 9, you're saying? There's no distinction between any of the 9. They're all 30 bips?
That's correct.
Okay.
And if you want to move to the next slide, I think what we can find is to touch on a lot of these points. And Raina mentioned this as well, is that, of course, when we're moving beyond cap weighting, we're making some implicit decisions. And what we think a strong decision to make in today's market is a focus on a multi-factor approach for all the reasons we mentioned. But, okay, well, let's say an investor buys into that. How do we really want to think about using them? Some investors might take a full-on supplementary type approach, as we put it, and this would be replacing existing exposures. in a certain market or certain country, maybe we really find that this particular benefit that quality mix brings is really what we want to harness. But others might use a more modest allocation to a quality mix approach. Maybe they have tracking error as a particular concern to them. And their decision might be based off of their conviction, the horizon that they have, any particular exposure that they want to have. Because what we find, again, using the same parent indices, we can exploit the combination of inexpensive valuation with high quality and low volatility companies that is really capturing some of the benefits that Buffett has done for years with a U.S.-based type approach.
Dave, I'm sorry. Let me just chime in really quick. I'm sorry to interrupt you, but when you talk about tracking error in this specific context, when you talk about the complementary piece, are you talking about benchmarking as a large institution might engage in, or some relatively sophisticated investor? Is that the meaning of tracking error in this particular context?
Yeah, well, most people have, even if you're not a large institution, most folks have some sort of investment policy statement, and we're looking to meet or exceed some particular benchmark. And from what we've seen and engaged with, most of this has just moved beyond, let's say, a U.S. concentrated type exposure. So, but in some cases, when we're making a decision, when we're choosing between either passive approaches or active approaches or this middle-based advanced beta factor type investing, we might not be comfortable taking on as much risk relative to our benchmark, just because if we use a single factor type approach, and in some markets it might do exceedingly well, and it's going to have superior performance. In others, maybe it underperforms significantly. And with the quality mix approach that combines things that do well in more positive economic environments versus those that might do well in market drawdowns or where there's more turbulence simply in the market, even if it's going up or down, that's really what I'm harnessing in regards to tracking error.
Right, and before you push on, when you talk about the first variable, the supplementary concept where you would replace an existing cap-weighted exposure with an SPOR, MSCI Quality Mix ETF, one of the 9, whatever they might be, and I presume there's going to be more. We can get into that later, but why would you do that? Would you be concerned with the possibility of an overweighting of a certain sector or a certain confined set of securities that are just really rallying hard and just going to revert to the mean in the worst kind of way eventually? I mean, what's the case there that someone could sort of come up with as they thought through this?
That's 100% correct. You could decompose and take a look at essentially the market for a particular country. You could use Canada for an example, with significant exposure to natural resources and energy and financial type companies. The quality mix approach, and that's just a function of its market. It's a function of those companies that are publicly traded, listed in that particular market. But what you could do with the quality mix approach is look back and essentially see in different market environments how well it's done. But even if you're less focused on past performance, which of course is not necessarily indicative of future results, we could still say, hey, in today's market, I see that the quality mix is tilted away from this particular company and this particular overconcentration. I want to take advantage of that in the portfolio going forward. And you can do that with these 9 ETFs in your toolkit.
Right. And Raina, can you just chime in really quickly and before David pushes on here, because I know he has more to say, but you talked about capping weighting of particular securities, and I think it's related to this what some people perceive as a problem with cap weighting. What are the caps for within this indexing methodology relative to individual securities or sectors? How do you conceptualize it? Can you lay that out for us really quickly?
Sure. Typically, it's really 5% on. If you just look at the quality indexes, we kind of do a cap of 5%. But then when we look at the min vol, we kind of do caps on different levels, like sectors, countries, stuff like that. So that's a little more because that kind of is a result of an optimization. So we kind of have different constraints, and the only constraint that is not there is on the min volatility or the low volatility factor. So really, I would look at just look at the quality index, really a 5% capping is what we look at a security level. So basically, we don't let a security become too large, even though in the market cap index it could become a very large security if the price is going through the roof.
And it's 5% for an individual security, is that correct?
Yes. Mm-hmm.
Okay. Dave, I wanted you get right back into it. I interrupted you right when you were getting into the conceptualization of longer term and the allocation decisions in connection with that. So please carry on.
No problem. I think you raised some good points, and in particular on that concentration side. So one particular exercise we wanted to look at was just in regards to the single country. I think at first glance, oftentimes investors can appreciate maybe how we want to use those regional approaches, but some of the real benefits that we're seeing investors take advantage of is single country investing. Just as sector rotation grew in the United States, single country investing is really now expanding globally. And in this example, we just simply take a look at essentially what GDP forecasts are, compare that to where the country weights would be in the broadest based approach, so using the MSCI Equity IMI, 99% of market capitalization globally, and we create a reweighted portfolio that's focused simply on GDP. Is GDP, of course, predictive of what earnings growth and what investors are willing to pay out for that earnings growth in the equity market? No, but it's a way to illustrate that these even with simply 6 countries, we can essentially play off of one another and create a rotation model among them using whatever thing you might want to take advantage of, whether or not that's economic momentum to single stock characteristics rolled up into the country. And to me, I think that is really one of the great benefits that a multi-factor type approach will bring, is that, again, it's not just any individual market that this does well in. There's evidence that this does well across multiple markets and within multiple countries. And if we want to move to the next slide, what we can see is that, again, this is jumping back to the broad-based approach, but again, here we can start to see, just as you alluded to within your question a few minutes ago, is what is this going to look like in regards to individual exposure? So how could I implement a view to avoid or maybe take advantage of some more favorable trends that we're seeing across sectors, or in this case, across countries as well? And in today's market, we can see that the MSCI World Quality Mix Index is overweight the United States, so an investor who remains bullish on U.S. performance relative to other regions can take advantage of that, drill down and avoid certain countries in Europe, for example, that may not be as favorable under this particular methodology. Or on the left-hand side of the screen, we can see the sector weightings and see how that would look, and avoid or take advantage of the fact that this approach has fairly healthy but not necessarily too aggressive overweight to healthcare and consumer staples. So a little bit more of a defensive tilt in that portfolio today, but one that's not necessarily also going to get into any particular issues, because we're, again, going completely into one direction or another and avoiding the benefits that having exposure to multiple securities can bring. Because one of the worst things we can do is essentially try to take advantage of a trend that becomes less implementable over time. Because this is done in a rules-based and consistent fashion, we are able to do that, and as the index goes through its rebalancing schedule, we will be reverting back to those equal weights in regards to each one of those individual factors, and allowing the portfolio in an index-based ETF to take advantage of what the quality mix approach is picking up in the market as, of course, markets adapt.
That's great. Yeah, I like how you isolated the U.S. there. And I'm looking at the other end of the alphabet, conveniently enough. I'm just cherry-picking this out of thin air. But Australia, turns out, has a much lower weighting in the quality mix index than does the MSCI World Index. And I don't know, maybe this is a Raina question, but I'm tempted to hear you speak to it the way Dave just did with regards to the United States on the flip side, which is to say there are good reasons to be in the U.S. if you have confidence in rule of law and good corporate governance and what have you. But with Australia, it's a bit strange. I mean, is this a reflection of the commodities juggernaut that has sort of slowed in the last 5 years, or what? Is there a rational explanation to what this index methodology is telling us there with regards to Australia?
Yeah, so it's so with Australia specifically, it's really I think it is the commodity story, and with Australia, it's kind of it's kind of difficult to pinpoint whether it's one particular factor because we do take value. Quality and min-vol kind of into account, but given that quality typically is are more like safer large cap companies, I'm guessing that kind of has a lower weight in Australia, as opposed to even the min-vol will give it a lower weight given commodities tend to be a little more volatile.
Got it. That's great. Thank you for that. Now, Dave, you alluded a moment ago saying that the research shows that this quality mix approach is quite applicable across the board. We can look at different markets, different ways of getting at the investable universe through various index methodologies, whether it's single countries or regions. Is there anything in the research that suggests that it's weaker in certain areas or certain countries for that matter, or is that a difficult thing to discern?
I think you're always going to find that in certain markets, one approach does better or worse based off of some nuances that exist out there. But I think when MSCI looked at developing this, and of course Raina could touch on her viewpoint, it's not just necessarily making a bet on any particular factor from a market timing perspective. So what do I mean by that? We could go and create the defensive portfolio and harnessing just on low volatility stocks and just on stocks that have low volatility, not just based off of their trading or their performance, but based on their earnings variability. We could get very sophisticated there if we wanted to and really reverse engineer that. Conversely, we could, and this is what investors have done for years on the valuation side, is look at what's really the best valuation multiple. Is it sales to price, free cash flow price, cash flow price? We could go on and on. And then on the quality side, which is, of course, one of the most debated factors, not that it exists, but how do you define it? But when we take the pro-cyclical that value can bring, combined with the more defensive low volatility and the uniqueness that quality actually can bring, that's when you see it really working well across markets. Because we're not just making a bet that one particular market has low volatility or one market is always inexpensive relative to its peers. It's looking across the board, across the cross-section of stocks in any given market to add that. And when we looked at the performance numbers, not just on the cumulative basis, also on the risk-adjusted basis, that's what we really see. And that, of course, was just for the world, but we could have plotted that for any particular market, any of the 9 that we've shown, and we can show something fairly similar. It's that, again, we're not necessarily going just for the highest returns all the time or just the lowest volatility. We're looking to do something that takes advantage of the uniqueness that each one of those approaches brings and combine them together to look to have a more stable return stream over the long run.
Great. Thanks, Dave. I wanted to remind the audience that you can ask questions at the lower right of your screens. You can submit questions, and we'll be happy to entertain them. We've got a few here so we can push forward. This question gets asked in a million ways, and this quality mix series of indexes seems to push the issue further into, the tortured and exquisitely calibrated zone. But it's tempting to look at this. We've talked about Warren Buffett in a bottle, or rather I have. I keep on throwing that out there, and I apologize if it seems excessive. But really, there's a serious purpose at the end of the day, and that is indexing methodologies are capturing the beta of Warren. Raina, I think you said that yourself, and I wanted to ask you, Raina, can you quantify the beta that's been captured there? So, what's left of Mr. Buffett's magic as you guys at MSCI and other index providers get more and more sophisticated in how you're approaching the investable universe? So again, the question is, Raina, can you quantify the beta that you're capturing here? And the broader question, maybe Dave, you want to take a crack at it, is indexing sort of slowly usurping active management? Raina?
Sure. So, it really obviously depends on which market you're looking at. But if you do look at, Buffett still does have a good amount of, I'll talk about it in terms of alpha because that kind of represents his skill set. He does still have a good amount of alpha, I would say about like 10% coming out of his stock selection skills. But that being said, the S&P, if you look at last year, the S&P 500 was up like 30%, right? And if you look at the factor premiums, depending on how they did, just capturing the beta through factor premium and then through the market, that gives you a significant amount of return. And then, of course, if you can hire a manager like Buffett, you can get an additional 10%, which I would totally take.
Dave, you want to take a crack at that? The sort of, at the risk of just, forcing the issue, the active versus passive debate that it now has been pushed into an even more, careful to or difficult to answer realm because of these indexes. These are interesting indexes. How would you handle that question?
Yeah, so State Street conducted a study actually last year that looked with institutional and intermediary investors in North America and Europe to try to identify some of the trends that they see in regards to smart beta. And what we actually find is that 70% of mandates that have been funded have come from active management. And in some cases, this is most likely to be expected. And what we find, some of that has to do maybe with they're just reallocating among underperforming managers, but a lot of it has to do with the fact that I think we're seeing an evolution of investing. And what the evolution is appreciating the spectrum of passive and active management and advanced beta, those investment approaches that can take advantage of factor premiums in a cost-effective fashion is the third wave. And now what we can do is, if we're going to use active management, spend our risk budget more wisely. Spend it on managers that actually are doing something quite unique that's very difficult to capture over the long run, or doing something that's not necessarily unique that's difficult to capture, but one that's maybe more illiquid in nature if we're really getting sophisticated out there. That's where I see the evolution going, and why advanced beta is not going to be going away anytime too soon, why it's not necessarily just a fad, in my opinion, is that it helps you build better portfolios. And those better portfolios are those that are going to be more cost-effective over the long run to investors, but also that can meet the particular needs that any individual portfolio may have.
Great. There's one question from the audience here that I think is worth answering. We're running out of time here, but the data that you guys have served up during this webinar regarding quality mix returns are, the word that's used here is simulated, but I think backtesting might be another way of framing that. Can you comment on that? Perhaps Raina?
Yeah, so basically we have, data going back to, in this presentation, to 1998. But actually we are, coming up with something which actually talks about 40 years of deep history. So we basically simulate data going back to 40 years to show how all these different indexes have done, and that's something you should see in the near future.
That's great. Well, that is about all the time we have. Certainly, I'll be looking closely at how these funds perform, these 9 that you spoke about, Dave, and we'll be looking to see if you guys develop this idea further. I suppose you'll have to see how these are received by the investing public, but this has been a very interesting webinar. That concludes the quality mix, more than the sum of its parts. Raina and David, thanks for being my guests, and I want to thank the audience for attending and asking some illuminating questions. And also a reminder that this deck of this webinar will be available to you in 24 to 48 hours, and you'll be each receiving an email to access it. On that note, on behalf of all my guests and all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a pleasant afternoon.